Hi, and welcome to Magic Scanner website, a fundamental stock selector for KLSE and SGX financial market. You're about to learn the secrets to raking in double to triple digit return per annum in trading or investing, no matter how much time you've had to prepare. It doesn't matter if you've never had any past experience or education, this Magic Scanner will tell you everything you need to know without spending too much brain power. This is unlike any tool you'll find out there. It's the edge that most analysts and fund managers want or have. Go ahead and get yours now.
Hello, everybody. Welcome to another radio show or TV show, whatever you call it. Okay, O and E. Mr. Chin here a lot, man. I don't think I can cover so many, man. Probably best is I'll probably just pick two out from your list. Okay. Welcome everybody to another Friday chart clinic dated 21st of June. If you've been following my blog for the June 2013, I did talk about market correction. And last week on my closing bell, those of you premium members, we are saying the likely to test the so-called 14. Let me just get back to my chart here. It's going to be a lag time on your side. The test, bringing this up, is the breakdown to the so-called gap up zone that we see between the 1720 and the 1750. This gap in here, definitely we've been tested in here. If we do see a sell-off tonight, this market is going to test back to 1730. More of this will be on my closing bell 4:15 update, which is also live webinar session that I normally do. Now the question did posed by someone, Carol, and said, what's the difference between Friday chart cleaning and Friday closing bell? Now both of them happen on Friday. Traditionally, what we've been doing on our Friday chart cleaning, we usually used to do it face to face back in the office in Phillip Capital in Kuala Lumpur. So where actually clients and also students of ours would come out and we sort of have a informal catch up and just looking at the charts, ways to help them out. But ever since I moved over to Jupiter, what we've been doing is try to do it over on the internet space where people, and we have a lot of like members and also premium members who have come in and joined our fraternity in here to be able to help them out. We got people as far back as to Australia and South Africa, who is Malaysian actually, in following this market, and that's how we've been supporting it. Now the Friday chart cleaning is a bit of a free format in the sense that anything you pop out and we can discuss regards to investing and trading on that nature. So it could be a topic that of interest, and today we have a very interesting topic that I've just thought of as I came before, something I want to talk about in terms of picking stocks to buy, right? And the evening session, which is the 4:15, we start about 20-25 minutes, is the Friday closing bell that I normally do. And what it does is I give a regional outlook plus a KLSC outlook for the week, meaning next week, and it runs every week. As long as I'm not on leave, I'll probably do this 50 to 45 to 50 times a month, and just to update you so you can catch this short webinar just to prep you and prepare you how the outlook would look like going forward. I think that's the whole purpose of my Friday closing bell. And those of you who is interested to subscribe as a premium member, there's many benefits of that. Of course, you can go to the website and subscribe it. All right, I won't talk about the outlook. I'll just keep it for this evening. But today is this topic here that I will do is the explore the relationship between PE and dividend yield. Okay, does okay, Chin, how much is a premium member? You can go on to the website or send me an email. Okay, now those of you who want to know about PE and dividend yield, does anybody know what's the relationship between these two? PE and dividend yield. There is actually, if you look from mathematically, there is now I'm just going to explore to you what's the difference between that, right? P, okay, this is going to be P divided by E. See, that's what I don't like about this. Okay, PE, then you have here multiplied by dividend, okay, which is dividend over price. Okay, can you see that? Now, that's the formula relationship between PE and dividend yield. Now, let's go back a bit more. Let me just explain what is PE stand. PE is basically mark the price over earning. It's a measurement that a lot of analysts and fund managers like myself, as well as a trader and broker, look at how expensive or how cheap the stock price is. Typically, if a stock is worth 1 ringgit, okay, if worth 1 ringgit and it makes 10 cent per share, 10 cent per share, and what's the PE? Can anybody tell me? So it makes 1 ringgit is the price, and the earnings is 10 cents. What is that? Does anybody know? Can anybody tell me that? Okay, can anybody tell me that? Right. All right, good. We got some answer yet. Okay, 10. Thanks a lot, Jason. Now that's correct. Okay, if you're here, I'll probably give you a price. Okay, that is the price. Correct. 10. Correct. So that's how we look at the PE. It's how expensive. So it also means that it will take, if the company continued to pay 10 cents earning every year and you bought it at $1 to recover back all your earnings, it will take 10 years. That's what it means. Meaning it will take 10 years to recover all the investment or price that you pay for. That is why we always say don't try to overpay the PE. And if you look in terms of KL, currently our overall PE for the market is about 16.9 times. So that's telling you, it will take 16.9 years to pay for everything. So how do you invest then, right? Of course, we invest partly due to the market appreciation from then onwards, but also we look at the dividend yield. Now, how do we compute dividend yield now? If you go on to the second equation here. Now, dividend yield is calculated as the dividend payment, because remember, in KLSC, dividend are paid sometimes 2 times, 3 times. There are some who paid a return on capital. For example, like Telecom Malaysia, in the last 2 years, they did pay 22 cents plus 30 cents as a return of capital, which is in terms can consider as a dividend payment too. So if you add that one up, you are looking sometime between 5 and 7% dividend yield, because they do pay the return of capital, because they find that, look, we are getting so much cash back, we're going to pay this as a reward to the shareholder. And sometimes they also call it as a special dividend. And consumer staple companies like JTI, GAB, Carlsberg are well known for all this. Partly is because if you look at the industry they are in, they don't need a lot of investment per se to plow back compared to the oil and gas and manufacturing. Oil and gas and those and manufacturing are very capital intensive. They are money hungry, capital hungry, that needs everyday kind of thing to pay for equipments. So that's why, you look at when there is a turn in the market, like now we are seeing potentially, there is talk now about Australia was possible a 30% chance of sliding into recession because of China's slowdown of that. But that will be another topic another time. So this is what we are talking about, is we want to be invested in company that is not cyclic driven, in the sense that if the economy do well, they'll do well. If the economy don't do well, don't do well. Now, why is this important? If you look at it, the dividend over price is the relationship. Now, if you look at the relationship between PE and dividend yield, you have these two formula. Dividend is dividend over P. Now, going back to the question, dividend they do pay in cents, 5 cents, 3 cents, 2 cents, 1 cent, 2 cents. So you will add up all the three payout and you divide it by the price that you have. Typically, dividend yield is always calculated back to last year. It's difficult to calculate forward because dividend payment is always paid based on if a company has a dividend policy statement. Typically, most capital intensive companies generally should not pay any dividend at all, because they need to plow back the capital, and those who want to pay probably only pay 30%. So sometimes when you hear company like manufacturing companies decided to pay 80% dividend, and they have to borrow from the banks because loans are quite cheap to pay dividend, what does that tell you about the company? Correct. So these are the things that we have to be careful. Why do company pay? Is it a payment to themselves, to their pockets, to their aunties and relative who is also crony of the company, or is it a genuine payment? Which is in the case like Telecom Malaysia last year did return the capital back because they couldn't want to reward the shareholder. So those things are important in respect to how we look at it. Okay. Now going back to this question, P over E dividend yield. Okay, A and M. Okay, Linda, A and M. Okay, thanks. All right, Linda. Now, if you take this equation P divided by E multiplied by dividend over E, if you cancel it out, what do you get? Huh? Dividend over earnings. Okay. Now, what is dividend over earnings? Now, dividend over earnings. Can anybody tell me what is dividend over earnings? This is very important in terms a very easy way to calculate the intrinsic value or the fair price value of the company. Can anybody tell me what's dividend over earnings? Okay. Anybody? This is a cost. Go back to teaching again. Okay. Good, Hannah. Yes, Hannah. Well done. Earnings given back to shareholder. That is correct. So this is what we call dividend payout. Okay, dividend payout. Now, very important. You want to know whether a company is now. If you look at in terms of a company, what do they have control? What do they have control? Out of the three elements here, price, dividend, or earnings, which is the one that they have most control? Right? Would you say? Please list the order. Okay. Out of these three elements, which is dividend? Okay. Second one is what? What is the second one they have control? And then followed by okay, earnings per share, and then finally is price. That's right. You all got it right. I think in terms of the most control one is dividend, number one. Second will be earnings, because earnings come from controlling the cost of the company, right? But the one that they have least control is price, because price is always based on a lot of macro and microeconomic factor, also looking at the sentiment or indicator based on this, or also analyst report that you can see this tons and tons been spilled out to it. They're saying this company, you can have four analysts looking at the same company, but four will give you four different valuation, four different prices, what is the target prices, and four reasons why this will fail, and four probably another two reasons why the company will pass. So this is how we look at it. Okay, so why we look at it is because things that we have control, that's the one we want to be focused is. Now, simply saying is, if a company will maintain the dividend policies of 30%. Now, a keynote is to make sure that dividend policies is always maintained in every company. Like this year, they say 30%. Next year, they say 40%. Okay, so the third year, if they already say 40%, suddenly now they say, hey, I'm going back to 20%. What does that tells you as an investor? Okay, what does that tell? Hi, Bill. What does that tell you? Bill is here. We'll probably give him an update on gold. There was some question, right? That tells you the company is not doing well. They have to cut back on dividend. And the first 2 years when they pay you 30% and 40% was because they were generous and they didn't give any thought about the future. So that is, to me, is what we call a Mossack theory that tells you something is not right about the company. Dividend policies must always try to be maintained as the industry or the maturity of the company that is growing. Companies which is consumer staple tend to pay higher dividend. As I said, they don't go back to it. Now, if you look at this, very simple. I give you an example. If the PE of a company currently, right, is 28 times. Okay, now take out your calculator. This is what you want to do. PE of a GAB is 28 and 29 times. Okay, the dividend yield is what? Dividend yield currently, let's say, is 3.5. You do the math and you tell me what is the payout ratio. Okay, let's say dividend PE is 29 times dividend yield of 3.5. Right? What does that tell you? Can someone tell me what's the answer? Okay, PE is 29 times, dividend yield is 3.5 times. If you multiply, what do you get that? What do you get? Hi? Yes, 101.5. Now remember, the dividend policy which is maintained by the company is only 80% or 96%. So which means, in order for this case the variable PE is overpriced. So if you look at it, if you look at 90% payout divided by the dividend yield 3.5, So we are looking at 25 times PE for GAB. So if you're buying now at GAB 28 times, okay, 28 divided by 25.7, so you're paying 9% overprice. So that's how you calculate whether the price is fair price or not price. Simple, right? You don't need to have an MBA to calculate that. But this formula only works for company who enforce dividend policies and they want to ensure the dividend payout is 3.5. Very simple. If you go to a lot of AGMs, they always say, what is your dividend yield? If the dividend yield drop to let's say 2.5 or 1.5, then a lot of companies, a lot of investors may not want to invest in it because they have to maintain 3 to 5. And if you go a bit deeper, some company pay 12%. Okay, that's correct, Henry. Some company pay 12%, 12.5% dividend yield, and the PE is 10 times, or let's say it's also 12 times. So they are paying 150%, no, the dividend payout. You see my point? So can that be done over a long term? So because of that, you have it's okay. So that is why we all have to be careful and calculate the intrinsic value of it. So that's all I just want to explore today. And actually, this is also part of something I teach in my value investing course to how to calculate this. Hopefully, that will give you some insights to it. And we will look at it more in depth on this is topic number 2 that we'll talk about is the second year 2013 market outlook, which is going to be on the 27th of December, right? Let me just do a bit of promotion. Now, on the 27th of December, this is normally we'll do our so-called second half outlook and sector to look at. So there will be 3 speakers in here, Bill, myself, and also Benny Lee. And also there was a request to invite one of the public listed company CEO to come in and talk. I'll probably try to invite one person to come. No names are given yet, but I hope to see all of you in our second half 2013 market outlook and also look at sectors to look at. Now, Bill is here in the room in here, and probably he'll give you a snapshot. And it's very excited after we came back from Bloomberg. A lot of insights too from our training there. And here you go, Bill. Take it away.
Yeah, thanks, Martin. Welcome, everybody, and I'm glad you guys could come. Just to let you know, I just came back from UOB Bank, the main headquarters branch near Masjid Jamid, and there was a big crowd down there buying gold coins. They had in stock some Canadian maple leaves and the 1 ounce Australian kangaroo. There was a bargain sale, a cheap sale. It was packed, and I saw people buying 20 and 30 coins at a time, just big stacks of cash. One guy had a doctor's bag, and he opened it up, and it was just filled with cash, 100 ringgit notes. He spent at least a couple of 100,000 buying gold. So I'm seeing this happen. I'm seeing the physical market very, very well supported. Premiums have increased dramatically in Shanghai this morning, up to $40 to $50 an ounce premium for cash over futures. Also, we find that gold now has been knocked down to the cost of production. And now what that means is a gold miner, what he can cost him to produce an ounce of gold, that's all he can sell it for. So that eliminates lots of hedging pressure on the market. Commercials, miners are the biggest sellers in the market. They have no incentive to sell. So in my opinion, I think the worst of the gold collapse is over. We're forming a very nice triple bottom. We're seeing the physical demand picking up dramatically. So having said that, you guys, if you want to get some gold, you better be fast. It's not going to be, it may be gone in the next 2 or 3 days, maybe all gone today. So go on down there and see the girl there and buy some gold. Okay, now going on to the next topic. Yesterday, Martin and I and our intern Tom, we went to this Bloomberg presentation, which was quite eye-opening, and this guy was explaining about finding value shares and measuring them in terms of a portfolio. Quite interesting. He talked about the outlook of Japan and China and how that affects all of Asia. And, I remember one statement he made, which was quite interesting. He says this: a cheap proxy. Okay. I'm sorry if I can find this. Okay, I wrote something down. I can't find it. Okay, but anyway, what he said was a cheap form of due diligence is cash in this environment. A cheap form of due diligence is cash. Remember that. It's a very wise saying. And I look at it in another way too. Another form of due diligence is buying value when it is at a discount, meaning we look for shares, obviously Martin has mentioned this, with a dividend yield with retained earnings of at least 40 to 50%, shares that perhaps are unpopular, that are not researched. We recently picked up telecom for all our clients. It hardly even moved. And shares with a low PE. So in that way, you're not playing the game of the crowd, the momentum crowd, who always says, well, hey, if I buy now, some sucker will